In 2013, a college dropout put $400 into a coin nobody could explain properly, not even the guy who created it as a joke. 7 years later, that same joke coin made him a millionaire before he turned 30. And here's the part that should bother you. He didn't understand blockchain technology. He didn't understand cryptography. He didn't even fully understand what he was buying. He just got lucky at the right moment in history. Stay with me for the next few minutes, because by the end of this video, you're going to understand something that 90% of people chasing crypto wealth completely miss. The difference between getting rich and staying rich, and why most crypto millionaires you've heard of are not who you think they are. Let's start with the number that gets thrown around every single day. Right now, there are hundreds of thousands of crypto millionaires across the world. Sounds incredible, right? A whole new class of wealthy people created out of nothing but code and belief. But here's the question nobody asks. How many of them actually cashed out? How many of them are millionaires only on a screen, watching a number go up and down, terrified to sell because selling means admitting the party might be over? This is the first economic truth about crypto wealth. Paper wealth and real wealth are not the same thing. A number in a wallet is not money until it becomes money, and the moment thousands of people try to convert that number into actual cash at the same time, the number itself starts collapsing. This is not a flaw in crypto. This is basic economics. Liquidity is not infinite. Markets move because of supply and demand, and when everyone rushes for the exit at once, there is no exit big enough. Now let's talk about how these millionaires are actually made, because the story is far less romantic than influencers make it sound. Most crypto fortunes were not built through some genius trading strategy. They were built through timing, and timing is not a skill you can teach. It's a coincidence dressed up as intelligence. The people who bought Bitcoin in 2011 for a few cents were not economic geniuses predicting the future of finance. Many of them were hobbyists, programmers, or people who simply had spare money and nothing better to do with it. They took a risk that felt irrational at the time, and it happened to pay off. For every person who got rich this way, there were thousands of others who took the exact same kind of risk on a different coin and lost everything. Survivorship bias is the invisible force behind every crypto millionaire story you've ever heard. You only hear from the winners. The losers don't make YouTube videos. The losers don't get interviewed. Their silence creates an illusion that the path to wealth was obvious, when in reality, it was a lottery with slightly better odds than a casino, dressed up in technical language to make it feel scientific. This brings us to a harder truth about the economics behind this entire industry. Cryptocurrency markets are what economists call thin markets. That means the amount of money required to move the price is much smaller than people assume. In traditional stock markets, moving the price of a major company requires billions of dollars and institutional weight. In crypto, especially with smaller coins, a handful of wealthy players can move prices with a fraction of that amount. This is exactly why you hear stories about coins pumping 400% in a week and then crashing back down just as fast. It's not organic growth. It's often coordinated buying by people who already hold large amounts of a coin, creating excitement, pulling in new buyers who see the price rising and panic buy out of fear of missing out, and then quietly selling into that demand. The new buyers become the liquidity that lets early holders cash out. This is not a conspiracy theory. This is a well-documented pattern that has happened over and over again, and understanding it is the difference between being the exit liquidity and being the one who exits. So why does this keep working? Why do smart, educated people keep falling for the same pattern? Because crypto exploits one of the most powerful forces in human psychology, the fear of missing out, combined with the dream of instant transformation. Traditional wealth building is slow, it's boring, it involves decades of saving, compound interest, and patience most people don't have. Crypto offers something traditional finance never could: the fantasy that an ordinary person with no special skills, no inheritance, and no connections could wake up in 6 months as a millionaire. That fantasy is emotionally intoxicating, and emotionally intoxicating ideas are exactly what markets are built to extract money from. The people who understand this dynamic are not necessarily smarter, they're colder. They understand that markets don't reward hope. Markets reward whoever understands human behavior well enough to predict how a crowd will react. Now let's talk about taxes, because this is the part almost nobody making these viral videos ever explains properly, and it's where a huge number of so-called crypto millionaires actually lose their fortune. In most countries, cryptocurrency gains are taxable the moment you convert them into cash, or sometimes even the moment you trade one coin for another. Imagine someone buys a coin for $1,000 and it grows to $500,000. On paper, they feel like a millionaire in the making, but when they finally cash out, a significant portion goes straight to taxes. If they didn't plan for this, if they spent money assuming the full amount was theirs, they can end up in a devastating situation where they owe more in taxes than they have left in cash. Because the market crashed after they made the trade, but before they paid the government. This has bankrupted real people. Not because crypto failed them, but because they didn't understand the basic economic reality that unrealized gains are not the same as usable money, and taxation doesn't care about your emotional attachment to a number. Let's go deeper into what actually separates the crypto millionaires who stay wealthy from the ones who lose it all within a few years. It comes down to one economic principle that applies to every form of wealth in human history: diversification. The people who built lasting wealth from crypto are almost never the ones who kept everything in crypto. They took profits along the way. They moved money into real estate, into traditional stock markets, into businesses, into assets that don't depend on the emotional mood of anonymous traders on the internet. The people who lost everything are almost always the ones who believed their own hype, who thought the coin would keep rising forever, who treated a highly speculative asset as if it were a guaranteed retirement plan. This is not a crypto problem specifically. This is what happens whenever any generation convinces itself that traditional economic principles no longer apply because a new technology feels revolutionary. The technology can be revolutionary. The math of risk and reward does not change. Here's something else worth understanding. The concept of a millionaire itself becomes distorted in the crypto world. Being a millionaire used to mean stability. It meant a paid-off house, investments generating steady income, financial security that didn't disappear overnight. Crypto millionaires often experience something completely different: extreme volatility even after becoming wealthy. Someone can be worth $2 million on a Monday and $800,000 by Friday without selling a single coin, without making a single mistake, purely because of market sentiment shifting overnight. This creates a strange psychological trap. People become anxious millionaires, terrified to enjoy their wealth because they know it could evaporate before they get the chance to use it. Traditional wealth builds confidence over time. Crypto wealth, for many, builds a permanent state of low-grade financial anxiety because the foundation it's built on is belief, sentiment, and speculation rather than tangible cash flow. Let's talk about the role of early adopters versus latecomers, because this explains almost everything about who wins and who loses in this space. Early adopters buy an asset when risk is extremely high and belief is extremely low. Because the risk is high, the potential reward is also high, and because very few people are buying, the price is low. As the asset becomes more popular, more people buy in, driving the price higher but also driving the risk lower because there's now more validation, more media attention, more social proof. By the time an asset reaches mainstream conversation, when your relatives are asking you about it at family gatherings, the majority of the explosive growth has usually already happened. Latecomers are essentially buying validation, not opportunity. They're paying a premium for the confidence that comes from social proof, and confidence is exactly the wrong thing to pay a premium for in speculative markets, because confidence is what peaks right before a correction. Now, here's where I have to be blunt with you, because most content about this topic won't be. If your plan for financial freedom is finding the next coin that will make you a millionaire overnight, you are not investing. You are gambling, and you are doing so in a market specifically designed to make gambling feel like strategy. That doesn't mean crypto has no place in a rational financial plan. It means crypto should be treated the same way a rational person treats any high-risk, high-reward asset, as a small percentage of a diversified portfolio, money you can genuinely afford to lose completely without it affecting your life. The people who build real wealth from crypto are not the ones betting their entire savings on a single coin because an anonymous account on social media promised it would go up. They're the ones who understood the odds, sized their risk appropriately, and treated emotional discipline as more valuable than any prediction about where the market is headed. There's also a bigger economic pattern happening here that most people never step back far enough to notice. Every time a new speculative technology emerges, it follows a nearly identical cycle throughout history. Early excitement, rapid price growth, mainstream attention, overinvestment by people with no real understanding of the underlying technology, a painful correction, and then, eventually, a smaller group of legitimate use cases that survive long after the hype dies down. This happened with railroads in the 1800s. It happened with radio companies in the 1920s. It happened with the dot-com boom in the late 1990s. Crypto is not exempt from this pattern just because it's digital and modern. The technology behind it may very well have lasting value. But the millionaire-making frenzy around it follows the same predictable human behavior that has repeated itself for over 2 centuries, because the technology changes, but human psychology does not. So what does this mean for you, watching this right now, maybe wondering if you missed your chance to become one of these crypto millionaires? Here's the honest answer: you didn't necessarily miss anything, because the game was never really about finding the perfect coin at the perfect time. It was always about understanding risk, avoiding emotional decision-making, and building wealth through principles that have worked for centuries: patience, diversification, and living below your means while your money works for you. Crypto can be part of that story, but it cannot be the entire story, because no single asset, no matter how revolutionary it seems, should ever hold the power to define your entire financial future. The real economics of crypto millionaires isn't a story about lucky winners and unlucky losers. It's a story about how quickly human beings will abandon basic financial logic when the promise of instant wealth is dangled in front of them, and how the very few who resist that temptation, who stay rational when everyone else is euphoric, are the ones who actually come out ahead in the long run. If there's one thing worth remembering after watching this, it's this: wealth that appears overnight can disappear just as fast. Wealth that lasts is built slowly, protected deliberately, and never depends entirely on a single bet, no matter how exciting that bet feels in the moment.